We have with us N. Sivaraman, President and Whole-Time Director at L&T Finance Holdings. Sivaraman, good morning. Thank you for joining us. No, we are not going to yet again rub salt on your wounds, as it were, and ask you about the bank license. Mr. A.M. Naik expressed your company's disappointment adequately. We have invited you actually for a different issue. The new Companies Act, we understand, has got stricter rules when all companies, including NBFCs, raise money through public debentures. Can you tell us if there are going to be more onerous conditions and raising money through debentures will become expensive?
So there are two areas that we need to really understand. One area is around creation of the debenture redemption reserve. The second one, in my view, is around the creation of security for the debentures. There is some ambiguity. In fact, in the previous time also similar notification was issued, indicating the rules. The NBFC segment did make a representation to the MCA, and there have been some changes which brought about. Basically that the guidelines will apply only to public issue of debentures, and the debenture redemption reserve requirement was also brought down to 25% of the publicly issued debentures maturing during the fiscal year. So I think I'm hopeful that we can get back and do that. But at the broader level, if you really compare a manufacturing company with a non-banking entity, there is a big difference. The non-banking entities are leveraged entities. They depend on borrowings as a way of really supporting their asset growth. On the asset side, their assets are far more liquid than that of a manufacturing company. Consequently, a stricter rule that applies to a manufacturing company to be extended to a non-banking entity, I would say that is getting a little too tighter on the NBFCs. If you understand the balance sheet of a non-banking entity, typically the leverage is about 6 to 8 times, and about 40 to 50% of their borrowings come from debentures, either publicly issued or privately placed. And if all the debentures have to be, the regulation will have to apply to all the debentures, it would mean about assuming about 30% of the debentures do mature on an annual basis, the debenture redemption reserve requirement will be close to 1 time the net worth of almost all the entities, especially those which have really mature and large, like ourselves or an HDFC or Sriram Transport. Each one of them will have to really provide for a significant amount of debenture redemption reserve. And I would say that given the typical capital structure, where we issue a good amount of new shares but premium, free reserves availability will be a bit of a constraint definitely to create this kind of a debenture redemption reserve, honestly. So I think we'll have to look at it in a slightly different manner, and the assets that of NBFC are far more liquid.
No, so Sivaraman, I take your arguments that it is unfair to apply them, but the Companies Act does apply to you all in this fashion, right? So what are you all going to do about it? Well, first up, how much more expensive will funds become?
Funds by themselves will not become more expensive. The compliance with especially the maintenance of liquid assets to the extent of 15% of debentures maturing during the fiscal year would really put some stress on the margins, meaning that we'll have to borrow and keep these deposits rather than lending it and earning a margin on this. We will end up having a negative carry of maybe 50, 75 bips depending on the individual entity's cost of borrowing, because you borrow from banks which are basically lent based on deposits, so there will always be a markup on that. So you will have a challenge on that front definitely. There will be a negative carry. Depending on the tenor for which you do that, to place the deposit, and the tenor for which you borrow at the same time, there could be a negative carry. So that will impact. So if you really look at it in a context, maybe about 15% of the debentures maturing, I would say that about 5% of the total balance sheet may have to be in the form of liquid assets to meet with the redemption requirements. So it's not going to be dramatically high, but it is an unnecessary cost, because large NBFCs like us in any case maintain a good amount of liquid assets because the balance sheets are large, there are going to be loan maturities coming back. One other point is that these NBFCs can also conserve or curtail the disbursement in the event they fear a liquidity issue on the market. They can easily pull back the disbursement and put the repayment of loans, including the redemption of debentures on priority. Okay, these are adjustments which flexibilities which are available, which may not be available in the case of a manufacturing company, because they are typically get into most of the borrowings are raised for fixed investment in fixed assets, because bank borrowings support the working capital. So the ability to liquidate an asset to be able to redeem the debentures is far more constrained in the case of manufacturing companies than that of an NBFC.
Mr. Sivaraman, good morning. We understand that the validity of this circular is being challenged legally, and that NBFCs have made a representation to the MCA for exemption to the Companies Act. By when do you think you could hear on that front whether NBFCs will eventually get exempted or not?
Yes, I think all of us have taken it up with MCA, both formally and informally, to be able to get this relaxed, given the justification that we have on the ground. Well, government at the moment is in an election mode. We do not know whether it will be approved at the level of the secretaries or will have to go to the minister. I think I would rather wait. We still have the full year ahead of us, so I'm sure there will be some resolution coming through on this subject, definitely.
So if there is, if say there's no resolution that comes through and you don't get exempt from this act, then what could the exact impact be, if you could quantify it for us, both on your margins as well as on your profitability?
So I think, as I mentioned, it will be a relatively smaller amount that we may have to maintain as a percentage of balance sheet. If I take say 40-50% of the balance sheet coming through the debenture issuances and about 1/3 maturing, you are required to keep 15% of about say 17% of the liabilities. So it may be around 2 to 3% of the total liabilities that we may have to maintain in the form of.
Sivaraman, this applies only to publicly. This applies to only publicly raised debentures, right? Not from. Not privately placed debentures. What percentage of your funds is publicly raised?
The previous rule.
Sorry.
Ours will be about 15%, but this rule applies to all debentures, whether publicly issued or privately placed. Okay. The previous rules were applicable only for the publicly issued debentures. So there was some relief available at that point of time.
Okay, that would be a double whammy.
I just had one question, since we have you with us, on what the situation is on the ground, because some financiers have pointed out that perhaps the worst of the commercial vehicle cycle or the infra cycle is now behind us. Are you seeing any signs of recovery at all?
Well, I must say that we are in the silent period, so I would rather refrain from making a comment or giving an outlook at this point of time. But our outlook, as we mentioned at the time of the third quarter results, has been that we should start seeing improvement from this quarter onwards. So I will just reiterate that, and let's wait to see how things pan out during the quarter.
All right, Sivaraman, we'll leave it at that. Thank you very much for joining us and giving us more color on how the new Companies Act might impact NBFCs. But of course, with the added caveat that NBFCs are speaking with the Ministry of Corporate Affairs and things could change. But at the moment, that's definitely a negative.